Gentlemen, good to see you both. David, let me begin with you. There was some talk about new methodology regarding autos, that there might be some noise and debate following the print. Is this conclusive to you in any way?
No, I mean, I think the big headline actually was this enormous 20% increase or almost 20% increase in airline fares. That added a tenth right off the bat to the numbers. But I think the real headline is inflation is still running hot and it's still likely to cool. I think what people are missing here is there's massive drag being imposed upon the economy from a declining deficit. The federal budget deficit is going to fall by about $1.7 trillion this year. We've got a massive trade deficit sucking money out of the economy. We've got a 2% increase in mortgage rates. This is breaking on the economy. It's going to slow the economy down. Inflation is going to fade. So it didn't really fade much this month. And people may be disappointed by that, but it is going to fade in the months ahead. And I think markets are kind of realizing that.
Ernesto, you go along with that? And does that explain, this early price action today?
Largely agree that inflation will start to decelerate. The question is how fast and how much is the Fed going to have to raise rates to get there and the ensuing slowdown that they're going to create. So we're basically in the middle of a regime change. We had a stimulus-led market for a number of years, and now fiscal stimulus has been unwound, and now monetary stimulus is starting to get unwound. And this is going to lead to a different market, a set of leaders in the marketplace. So we're in the middle of that. And we'd rather be defensive at this point and stay in companies that are not exposed to much of the economy and are really insulated from the cycle, because we can't tell exactly when the dust will settle on inflation, on supply chain disruptions, and all of the uncertainties that are driving this market or volatility in this market.
Yeah. Hey, David, if anything, over the last 20 years, we've learned cycles tend to be a lot shorter these days. Everything seems to move faster. Ernesto just asked a question. I'll ask it of you. When do you start to expect to see real signs of inflation slowing and therefore the demand destruction that perhaps you're talking about coming along with it?
I think later this year, August, September, I think we're going to see that inflation number begin to ease off. I mean, the key thing here is some resolution or something in Ukraine. I mean, it's a horrible, horrible situation. But at some stage, you suppose Vladimir Putin has to cut his losses. And if you can come to some sort of ceasefire or something that will take some of the uncertainty out of energy markets, that will help. But also, again, remember all this drag on demand. I think it's really significant that real food spending was down in the first quarter. Real spending on apparel was down in the first quarter. There are a lot of lower and middle income households who don't have the extra money they had a year ago. And that's going to have an impact on, food prices are up a lot. I don't think they're going to stay up as consumer budgets get squeezed here. So I think by the fall, we're going to see inflation come down. I just don't want the Fed to overreact right now.
Ernesto, I think it's pretty baked in, this idea of inflation peaking and starting to come off, in large part because we've got tougher comps that we're going to be lapping. But there's a big difference between peaking and rolling over and then peaking and staying elevated. So at what point do investors start to more meaningfully invest in equities, for example? What do you need to see in terms of data points to know what that trajectory is actually looking like?
Well, you need to see, first of all, that the Fed medicine is working, and you're starting to see that. As David pointed out, there's expectations that consumers are starting to slow down. So the unfortunate thing is the Fed medicine working means that economic slowdown will take place. So how fast is that going to happen? I think the Fed doesn't even know that. We are looking at the data points today. We got a bit of a higher print than inflation than expected. So we're going to have to look at the data points. That's just one side of the equation. That's the demand side of the equation. The supply side of the equation, when are COVID lockdowns in China going to end? And how is the evolution of the war in Ukraine going to impact agricultural food prices, both sources of inflation? So that part is not in control of the Fed, nor can be easily, if at all, predicted. So we can only focus, the Fed can only focus on the demand side of the equation, and they're going to have to really put the brakes on hard, which they've indicated, and the Fed futures market is expecting will happen. And the slowdown that will ensue, the question is, will it lead to a recession, or will they be able to finesse that infamous soft landing? And that's the big question that investors need to see before they commit to the market in a more meaningful way.